Welcome friends to the Bullish Money YouTube channel. It is time for another unfiltered session. So let's get straight to the headlines. This is from Reuters. Weak U.S. consumer sentiment, tame inflation, muddy Fed rate outlook. What a awkward headline here, but anyways, we go down, first paragraph, U.S. consumer sentiment hit its lowest in a year in early September, and producer prices were flat in August, signaling moderate economic growth and tame inflation could weigh on the Federal Reserve's decision whether to hike interest rates next week, which is, of course, this coming week. I gotta tell you that ultimately, it truly does not matter whether the Fed, increases the interest rates or keeps interest rates artificially low, because people think that this is a supply problem, right? I mean, the mainstream constantly believe that this is a supply problem, that the fluctuation of the supply of the bonds that are available to the public, that somehow could resolve the economic malaise that everybody is suffering. And that's really not the case here. The case is not about supply, it is about demand. This goes back to economics 101, supply and demand. And right now there is such an imbalance between supply and demand. And so adding more supply to which there is already enough supply really doesn't solve the problem. If it was a supply problem, then more supply would resolve the issue. But we don't have a supply problem, we have a demand problem. And the demand is simply the economy, the jobs. People are not having substantive wages, and therefore there is a lack of demand. There's a dearth of demand, whether it comes in the form of consumer sentiment or whether it comes in the form of equity valuation. There is just simply not enough demand. Not enough demand domestically, not enough demand internationally. China imploding is just another form of evidence that there simply isn't enough demand to go around in the speculative economy that we've built up. We've built up essentially an economy that is built on air and paper promises. And right now, those paper promises are seeking the actualization from real demand. But unfortunately, there is no demand. There's just simply no demand. So the supply is out there searching, hey, where's the demand to, put this equation into equilibrium? And those fake paper promises, even though they're fake, they're still part of the equation. I mean, they're still part of a monetary equation. You can't have just a bunch of debt obligations on one side of the account and not have some kind of resolution on the other side of the equation. You can't artificially imbalance this very basic accounting principle. There's no point in trying to paper up more paper. I mean, really, what are you going to do? I mean, does it really matter at this point? No, my opinion is that it doesn't matter. Anyways, let's get down into some more from this article. The slump in consumer sentiment and persistently weak inflation reported on Friday are in stark contrast with a tightening labor market. That's not true. Sentiment was likely undermined by recent stock market volatility amid worries over China's slowing economy, while a strong dollar is dampening price pressures. Notice that they're focusing a lot on China and our strong dollar. This has really nothing to do with the issue. It has nothing to do with the issue. I mean, yeah, it matters somewhat, but it only matters to the people that have money in the stock market. And right now, people, just regular folks, they don't have that much money in the stock market. Certainly not as much money as they used to. I mean, CNBC, before all this craziness occurred, they've been reporting that we just don't have that many people. The volume in the stock market is just much lower than it was prior to the 2008 financial crisis. Well, no shit. No shit. I mean, what you saw in 2008 was not only a depletion of equity valuation, but you also saw a depletion of participation. And I'm sorry, I don't care what country you are, whether you're as big as the United States, a global leader, or you're some kind of country like Bangladesh or whatever. I mean, I don't care what you are. Ultimately, you gotta have participation in something like a stock market and something like the equity markets. You just have to have participation. You have to have participation by regular folks, not just the rich guys. The rich guys, you know, they're not always going to be able to prop up the equities for you. You gotta have mass scale participation, and that's something that we don't have. So, I mean, you know, the Reuters mentioning stock market volatility, yeah, at this point it really only affects the mutual fund managers, and there's not that many of them, and the mutual fund managers, they're managing the money from the very few people, relatively speaking, to the general population. They're just managing very few people's money, and that really doesn't have enough leverage for most of America to be concerned about stock market volatility or China's slowing economy or the strong US dollar. In fact, the strong US dollar should be a good thing. See, and that right there, it just shows you how, you know, topsy-turvy, how upside down everything has become in this generation, in this current time. Because a strong currency means lower prices, generally speaking. And lower prices, my goodness, why would anybody complain about lower prices? Unless there's something fundamentally wrong with the economy. There's no reason to overcomplicate this, guys. I mean, there really isn't. I mean, people come out with their statistics and they come out with, you know, these little granular charts and stuff. Like, oh, look at this technical chart here, and you can see the volatility index, you know, jumping up by, you know, 5 basis points. Again, I mean, who cares about this stuff? I mean, you know, I mean, we can allow that for the mathematicians to argue over, but ultimately, this is about your money, your retirement, and it really comes down to just black and white fundamentals. There has to be an appropriate balance here, and when there's not an appropriate balance, that is a critical signal that something is wrong. And right now, I've got to tell you that if your guys are, you know, if people are complaining, if the mainstream media is complaining about a strong dollar, that should tip you off. I do want to hit up on this idea that the slump in consumer sentiment and persistently weak inflation are in stark contrast with a tightening labor market. I have to admit that I'm very, very confused, you know, by this sentence, because now maybe it's because I showed some facts about the labor market, right? And I showed you in that video about the August jobs report that was released in early September. I showed you that the economy has basically shifted from one that produces most of its jobs in the first half of the year to one post-2008, post, you know, Great Recession, an economy that produces most of its jobs in the second half. And when an economy produces most of its jobs in the second half, I argue that that is mainly because these types of jobs are being produced by the retail segment. A retail segment, obviously, you know, the third and fourth quarters are very, very critical. You know, that's where you have most of the biggest holiday shopping seasons. So the third and fourth quarters, that's going to be absolutely critical, you know, for the retail market. And naturally, the retail market is the one that is producing most of these jobs. Unfortunately, most of these jobs are minimum wage, Walmart, Target jobs that don't go anywhere. Prior to the Great Recession, we were producing most of our jobs nominally in the first half. Now, the first half is the weakest for the retail segment. That means that the jobs that were being created naturally are more substantive jobs, jobs that have actual career potential, that are not just a bunch of minimum wage warehousing jobs, you know, pushing boxes around. So that's the problem. So I don't see how this is in stark contrast to anything. I mean, a slump in consumer sentiment and weak inflation, or in this case, deflation. So slump in consumer sentiment and deflation are very congruent, not in stark contrast, but are congruent with an economy that produces most of its jobs nominally in the second half of the year. It matches. The data perfectly matches, because second half jobs are Walmart jobs, are Target jobs. They don't pay that much money. And so the workers, they're working their butts off and they're making minimum wage. Well, of course, they're not going to spend money, so there's not an inflationary pressure there because they're not making that much money. So therefore, you get the persistently weak inflation. Also, because these are minimum wage jobs, the consumer sentiment is very low. Why would consumer sentiment be high if everybody has Walmart or Target jobs that don't go anywhere? Of course, your sentiment, both from a consumer perspective and from a personal perspective, your whole confidence, your whole self-image will be depleted if all you can get are Walmart and Target jobs. So it's a stark contrast with a tightening labor market. I don't see the contrast here. I find this word to be very, very confusing, because it is absolutely congruent with the real data, with the real interpretation of the economic statistics that our government agencies produce for us lovely people. So I don't know what's going on, but I mean, this is what you get when you have the federal government always, getting their hands on the data, because I haven't, there's nothing that the federal government touches that doesn't get muddied up. So this is just, this data, I mean, it's just another example. And then also the government-controlled mainstream media, I mean, here you go. I mean, they're just constantly pumping out inaccurate information, hoping that you're not paying attention. Hoping like, I don't know why inflation is so low. Yeah, I have no idea. It's so strange. It must be because of China. Everything must be, it's the Asian man's fault, isn't it? Always the Asian man's fault that we got these problems. Well, guess what? It has nothing to do with China. It has nothing to do with stock market volatility. It has nothing to do with the strong dollar. Okay, the tail doesn't chase the dog. That's the point here. The point is that all of these things that I mentioned, those are symptoms. Those are symptoms of the demand issue. We just simply don't have real demand. If you don't have real demand, you don't have a real economy. We'll be right back. I don't think it really matters, so I'm not gonna be all worried and anxious about whether Janet Yellen will pull the plug or not. I don't care really. But it's interesting, I was looking at the technical charts for the 10-year US Treasury yields. And when you look at it from a technical analysis perspective, you have to say that the chart looks like it's forming a bearish head and shoulders formation, which is amongst the patterns that are studied in the technical analysis discipline. The head and shoulders is one of the most commonly cited, and it is believed to have the highest probability of predicting the future trajectory of a stock or a publicly traded asset. And what you see here is interest rates starting to climb, but they're climbing and forming it's kind of broken, but nevertheless it does look aesthetically, at least, like a bearish head and shoulders formation as we're heading into this announcement that interest rates will probably move higher. So I don't know what everybody else thinks. I don't know how the insiders are interpreting the data, but to me it just looks like, at least from purely technical analysis perspective, it looks like the interest rates are going to actually, the yields are going to move lower. So if technical analysis is a guide, it would suggest that there is greater than 50-50 probability that we're going to see Janet Yellen continue to keep suppressing interest rates. That would be very interesting, wouldn't it? But ultimately, would it matter? And I would say again and again and again, no, no, no. It simply it simply wouldn't matter. I mean, what does interest rates, you know, what does it do? You know, I mean, at this point, so many companies, blue chip companies that are traded in the S&P 500, they are running massive debt levels. Now, granted, those debt levels came, I mean, I'm assuming, of course, I can't speak for every single company, but I'm assuming that most of those companies, that they have acquired their debt during a period of low interest rates. So the servicing of that debt, okay, is not going to be as onerous as if interest rates were, you know, obviously higher. Then they would have to pay higher financing charges. But if the interest rates were to go higher, okay, then companies, you know, the Wall Street people say that the markets have already priced in interest rate hikes. I don't think so. I don't think they know what they're talking about, because the companies that already have massive debt problems, like, you know, JCPenney, yes, they may have already carried the debt burden, a majority of the debt burden, in years prior when interest rates were lower. But once the interest rates move higher, they won't be able to simply acquire more debt, because if they acquire more debt, they're going to acquire it at a higher rate. They would have to pay higher costs. And so that would stymie their ability to invest for the future. Because these companies that have massive debt problems, massive debt to equity ratios, these companies will not be able to invest for the future. That as they face the future, they have to service a past debt obligation. And a lot of companies are like this. You know, you can't just say, we can't just pick on JCPenney and say, this is the only company that has massive debt. Because so many companies, as I said before, have massive debt problems. They are past problems that have to be serviced in the future. Now, companies that don't have debt problems, they will be able to invest for the future. But here's the thing, if interest rates move higher, the incentive to borrow that money, to borrow cheap money, is gone, because the money is no longer cheap. So now companies that would otherwise be incentivized to take on some debt to be able to capitalize for the future, they're not going to do that anymore, or they're going to diminish that kind of activity. And so we're going to see a further deflationary pressure in the markets if interest rates move higher. Now, if interest rates move lower, people might say, well, then you would have the opposite problem, or excuse me, you would have the opposite situation. Companies will be incentivized to borrow that cheap money and invest for the future. And I say not quite, because investing for the future means that you foresee some kind of demand there, that there's some kind of potential for which you would put up the risk. That there will be some kind of reward that makes it worthwhile to put capital at risk. But the problem, again, as we go back to the first segment, the problem has always been about demand. And what you see in China and the emerging markets complex, there is no demand. A lot of that demand was bullshit. That's why you see so many skyscrapers that are empty, so many towns and new developments that are empty, because the demand was bullshit. So if there's bullshit demand, and a lot of the CEOs are savvy to that information, why would they put any capital at risk? So either way, I believe you're going to get deflation. Whether you like it or not, there's going to be deflation. And that is going to really crush the soul and the spirit of the global economy. But it is really going to be a major awakening for American companies that think that, you know, the Federal Reserve and Janet Yellen will be able to save the day. No one is going to be able to save the day. We've already fired the last weapons. That's what I mean when I said in previous videos that we fired our last weapons. We don't have any weapons. There is no demand. So adding more supply to that situation, what are you going to do? unfortunately, you can't do anything. Those are my thoughts for the day. Please subscribe to the Bullish Money YouTube channel, and we'll see you next time.